Let's talk about dynamic investing. A little backstory here. So, my career started off as an engineer, and I quickly realized that I wanted to better understand, how can my money make me money? And that led me down a path initially of trading and then found passive investing, index investing, settled on that for a while, but at a certain point started to question things. And this playbook that we're going to run through is really the culmination of years and years of research, development, asking questions, and ultimately trying to find a better way. And so what I realized was that most of the traditional investment advice, a lot of financial advisors, will recommend just buy and hold. Right, we're going to come up with some type of static allocation. You're going to have a percentage of stocks and bonds based on your risk tolerance, and we're going to just let it ride. Now, this never really made sense to me, in part because I would ask questions like, well, how come you never recommend gold or real estate or crypto or other asset classes within that? It's always just stocks and bonds. And what happens when bonds don't hold up the portfolio like they did in 2022? You have a problem. And so this playbook we're going to run through is really kind of walking through my thought process as well as ultimately how we invest for our clients. So, what I think most people want, and you probably relate to this, is you really want your money to grow, and you don't want to lose it, right? You want to know that your money is going to be there when you need it or want it. You don't want to have the constant stress of watching markets swing up and down. And you'd probably prefer to spend your money, travel, give, or retire with confidence. And so you want to protect your lifestyle through all conditions, not just when markets are rising. And that's where the buy and hold strategy has some challenges, because what do you do when markets are down? And you just have to be patient, right? Well, that's not always the most fun. And as we'll talk about, that can lead to some challenges. So the true measure, though, of investing isn't necessarily beating the S&P 500 or some arbitrary index. It's really whether your money actually supports your life. And so that's where we want to start from. What are your goals? What are your objectives? What is this money for? And again, the more we can keep that around, the more we can help that grow. Chances are that's going to help your goals, but it's an important thing to frame the conversation. So some of the problems I see with the traditional approach of just buy an index fund, hold on forever, don't worry about the ups and downs, the market always goes up in the long run. It sounds comforting, but oftentimes is misleading. So first of all, markets aren't static. Today's environment is nothing like it was 20 or 40 years ago. So we have different conditions. And a big thing there is interest rates. So since the 80s up until about 2020, there was a 40-year period where interest rates were in a very significant decline. And that period was very good for bonds. As interest rates go down, the value of bonds go up. And bonds worked very well in a portfolio opposite of stocks. And they didn't have as significant of a drag. And they also served as kind of a risk-off type asset. So if stocks are falling, then a lot of times bonds will go up. And so it provided a nice balance to the portfolio. Well, today's environment is a little bit different. We now are more of in a rising interest rate environment. After 2020, interest rates hit zero, basically, effectively, and they've started to climb. And we're also seeing a lot of countries reducing their reliance on the US dollar and therefore buying less US treasuries. And treasuries as a risk-off type asset is not working the same as it used to. So those are some pretty big conditions that ultimately change the dynamic around the effectiveness of bonds in particular, but also just go to point out that markets aren't static. Things change, and we want to adjust and understand the type of environment that we're in when we think about our allocation. Some other challenges with the traditional approach: drawdowns. So a 30-50% drawdown hurts. it's a big deal. And if you've ever experienced that, it's not that much fun. And so through a lot of the recessions over history, we've experienced 30 to 50% declines in the general market. And that takes a lot to recover. And so you can actually see here in this chart, if a 30% decline requires a 43% increase just to get back to break even. 50% requires 100%, right? If you're at 100, you're down to 50. Well, you need 100% increase to go from 50 to 100. So those declines have a significant impact on the compounding of your portfolio over time. Just holding on a lot of times can be unrealistic. People tend to panic when you've watched your account drop 40%. It's difficult to not have an emotional reaction to that. If you're nearing retirement or in retirement, that is your life. Like, that is what you're relying on to fund your living, maybe some travel, different goals, helping out kids and family. So there's very real consequences to that. And sure, you can wait, but who really likes to wait, and for how long? So the other thing about the traditional approach is it's built around averages, not just your goals. And again, passive strategies are going to capture what the market gives, but the market doesn't care about you or your timeline, your lifestyle, your objectives. So if you don't have any control over that, your entire life is just at the whim of the market. Not a place that I would want to be. So the passive approach is really built on hope that you won't panic, hope that the market bails you out, and hope that you happen to retire at a good time for a good cycle. The hope, it's not a strategy. It's a girl's name. So this is some of the things that fueled my search for a better path forward. And what I discovered was a dynamic strategy can make a lot more sense. So when we think about those drawdowns, we think about just holding on. Think about how the market has changed and that lack of alignment between what people really want. I realized that, staying passive just wasn't enough. And we'll talk about here some of the arguments sort of against that, or why people try to, they steer away from more active strategies. But the reality is that people beat the market. People beat the market all the time. It's not easy. There's not a lot of them, but it's not impossible, right? And so for me to just settle on being average or accepting average just never made sense. Like, that's not how I'm wired. I want to win. And not everyone's necessarily that way, and that's fine. But I wanted to figure out, how can I be better? How can I not be subject to the ups and downs, the being at the whim of the market? I wanted more. And so this all kind of drove my desire to learn and understand and figure out, how can we win? How can we do this better? How can we have a better approach? So there's 4 key principles of our dynamic investing strategy. And it's really around, trying to move away from, do you want to be aggressive, moderately aggressive, conservative, moderately conservative? That just, again, doesn't really make sense to me, because it depends, right? The relative risk in the market changes. But we've got 4 key principles. First is protect first, grow second. So back to the point before, we don't want to interrupt that compounding. Compounding is a very powerful force. We want to continue to let that do its thing in the positive direction. It also works negatively. So we don't want to compound those losses. We want to protect the downside and try to stay away from larger drawdowns. The second principle is we want to read the environment. So there's different cycles, right? We have the business cycle, the economic cycle, and markets move in these cycles. Things don't go up forever and they don't go down forever. And there's different periods and there's different, macro or economic conditions that lend themselves to more positive conditions and more negative conditions for markets. We want to understand, where do we think we are today? And then that gives us an idea about where we might be headed. Now, we're not trying to predict the future, but we can look at this from a probability-based perspective of, if you think about just at a high level, if we just came out of a recession, chances are we're probably not going right back into one, right? It's not impossible, but it's probably less likely. And so again, when we're thinking about cycles, if we can understand, roughly where we think we are today and or where we've been, it gives us an idea probabilistically about where we might be headed. And again, there's different assets that perform better and worse in different environments, and that's how we want to position. The third principle is around adjusting the risk dial. So again, a lot of times you're forced to say, well, do you want to be aggressive? Do you want to be moderately aggressive? Do you want to be conservative, moderately conservative? But the reality is, like, people want their money to grow and they don't want to lose it. So, and if you pick a conservative allocation, historically that has underperformed quite significantly. So if you technically, sort of, the right answer is to be as aggressive as possible. You just have to be patient and withstand those declines and those drawdowns. That over long time periods historically has led to better returns. But again, that doesn't necessarily line up with your goals and your objectives. If you're coming into retirement or, right around that period, you don't necessarily want to, lose 30, 40% of your portfolio and then push your retirement back 5+ years, right? So if we can understand if we have favorable conditions or risky conditions, we can tilt the portfolio to be more aggressive or more conservative depending on the environment that we're in. Now, these adjustments that we make are typically fairly gradual. We're usually not 100% cash, 100% aggressive, 100% cash, 100% aggressive. We're really shifting, 10, 20, 30% of the portfolio at a time to kind of make these more gradual adjustments. And that allows us to stay in the market and also minimize some of the consequences of poor timing or getting that wrong, right? So if we're all in or all out, we're either 100% right or 100% wrong. So when we shift and make these more gradual adjustments, it allows us to maintain exposure and provide a little more diversification and balance across the portfolio. So the last principle is about staying disciplined and not emotional. I've been known to be called a robot. And so I feel like I have a good disconnection or can disconnect between the emotions, especially around money and investments, with making decisions. And when things are going up, it's very difficult to not have some emotional attachment to that, as well as when things are going down. And buying into an investment is one thing, but selling is much more difficult. Selling is really the hard part of knowing when to get out. And when things are going crazy, it's easy to get excited, and then usually people ride things up and they ride them down. So we want to stay grounded, we want to stay disciplined, and use a combination of the macro environment, technical signals, allocation ranges, etc., to really rely on that discipline of how we want to handle what the market's doing. So what you get from this dynamic investing strategy is really the best of both worlds. Growth when it makes sense and protection when it matters. You don't have to choose between being aggressive forever or being conservative forever. We're going to allocate in between those based off the environment that we're in. So some of the objections a lot of times that I hear are, you can't time the market. And I would agree with that. No one can perfectly call every single exact top and exact bottom. But this isn't about perfect timing. It's about adapting intelligently to different conditions and ultimately tilting the odds in your favor without having to know exactly what's going to happen in the future, because that's not possible. So instead of just sitting around idle and hoping that things work out for the best, we would rather act when there's a significant amount of evidence that supports a particular direction. And again, it's about probabilities, and it's about relative positioning that overweight and underweight into where we think things are headed. We can also react quickly if we realize that that's not the case. So I'm not here to try to be right. I'm here to make money. And you don't have to be right all the time to make money if you have proper position sizing and you do it correctly. Another common objection is active managers underperform the index. So there's a fair number of studies about this. As far as I've seen, pretty much all of them typically focus on large cap equity funds. Well, that's pretty much the most efficient market on earth. And especially in the last handful of years, the general stock market, the S&P 500, as well as, which is large cap companies, has been driven by what they call the Magnificent Seven, which is 7 companies out of that. So if you didn't own those 7 companies, then it was very, very difficult to outperform in any way, because that was the main driver of the market as a whole. So if you look at bond funds, there are studies that show that active bond managers on average outperform passive bond funds. And in smaller markets, small cap funds, emerging, international, etc., again, a lot of times those active funds will outperform. But what none of this is really talking about is, I don't care about beating the large cap benchmark. I don't care about beating the international equity benchmark. I care about making money and not losing it, right? So the goal is not to beat the S&P or beat some index. It's to deliver better risk adjusted returns across all assets. And that's where things like gold, real estate, commodities, Bitcoin, etc., can all come into play, because there are periods of time where those work well and periods of time where they don't. And if you look at traditional asset allocation methodologies, they typically ignore a lot of those, because for the time frame that those studies and research has been done, they maybe didn't perform as well as stocks and bonds. But there are periods within that they did. And so again, I would rather hold, like last year's a good example. Gold was up, I think, around 60%. Silver was up almost 150%. Does it do that every year? No, definitely not. But that makes a big difference in a portfolio. And, we had a significant allocation to that, which was a big part for our outsized returns. So another objection a lot of times is, well, what if you miss the best days? Well, what if you miss the worst days? I almost never see one of these, charts or graphics where people talk about missing the worst days. They only talk about missing the best days, which again doesn't make any sense. Like, of course, if you miss the best days, your portfolio returns are going to be less, right? What happens if you miss the worst days? Well, that makes an even bigger impact, right? So you can see here that $10,000 invested in the S&P from 1995 to 2024. Buy and hold gave you about, went from 10,000 to 218,000. If you missed the 10 best days, it was about half of that. But if you missed the 10 worst days, it was over double, right? So, being able to avoid some of those worst days makes a huge difference. Now, if we miss both the worst and the best, it averages out to, fairly similar to the buy and hold. But our strategy is really not about being in or out on any given day. It's about smoothing the ride, minimizing the significant declines, and ultimately trying to protect you from losses that are going to take years and years to recover. Because thinking about this in terms of time is another good way to envision it. What happens? I was talking to a prospective client the other day, and he's been managing his own portfolio for his whole life and did really well coming out of COVID, as did pretty much everyone, because the market was ripping up. But then in 2022, had a pretty rough year, and lost about 40% of his retirement and overall portfolio. And that took years to ultimately recover from. 3 to 4 years of real time just to get back to where he was. And so how would that make you feel if your retirement gets pushed back, 3, 4, 5 years because, you weren't effectively managing risk? Another common objection is that, markets always go up in the long term. So why bother? Why put in this effort? Well, that has been true, but as the typical disclaimer is, past results are not an indication of, are not a guarantee of future. That doesn't mean they always have to be that way. And there's been quite a few periods where the stock market has been relatively flat for 10 plus years, both in the US and in other markets. And so in Japan, they had a 35-year period. It took from 1989 to 2024 for their stock market to get back to its prior high. That's crazy. And that does not include inflation, right? So when you factor in inflation, you've been losing purchasing power the entire time. So, if you need your money in 10 to 15 years, just wait can cost you everything. So how ultimately do we do this? we use a combination of kind of three key levers. So we've got macro analysis. We want to understand the seasons that we're in. So here's a good framework for that. You can think of this like spring, summer, fall, winter. Again, things run in cycles. That's not always perfect. It doesn't always go how the typical seasons go, but there is sort of a correlation between that. And so if we think about spring, that's where we've got rising growth, falling inflation. Things are starting to look promising. Summer is where usually markets are going pretty strong. Fall, things are starting to slow down. We've got rising inflation. And then winter is usually where we think of like a recession or a crash. And we've got slowing growth, slowing inflation. Now, there are different assets that rise and fall in each of these different seasons. So that's where we want to understand what season are we in, what season are we likely headed to, which assets are best in those types of environments, and position accordingly. So beyond that, we've got market signals. And so we do a lot of technical analysis and looking at charts to understand trends, support and resistance levels, momentum, and that gives us a good idea about what the market's saying. So this is something that you don't hear a lot, but really the only thing that you need to know when it comes to investing is the price. The price of an asset tells you everything you need to know, because that is the summary of all current information about what that asset is worth. And so there's a lot that you can learn by studying the price, which is ultimately through looking at charts and what that price has done historically. The last lever here is risk controls. So, not flipping all in, all out, but again, tilting, 10, 20, 30% at a time of the portfolio and, sort of adjusting things as we navigate through markets, as well as, proper position sizing, not being overly exposed to a single asset, single sector, etc. And this gives us better control over managing that risk. So at the end of the day, we want to protect when it's time to be cautious, and we want to push forward when it's time to be bold. So why does this matter for you? Well, most investors feel trapped between two bad options. You can play it safe and risk missing out, or you can be aggressive and risk losing too much. Well, that didn't work for me, and I'm guessing it doesn't work for you. You don't have to settle for either or just for being average. Average investors panic, average investors accept big losses, and average investors hope that the market eventually bails them out. But this is your life, and you deserve better than average. So with our dynamic investing strategy, you don't have to pick a side. You get growth when it's time to be bold, protection when it's time to be cautious, and confidence all the time. So if you're interested in learning more, shoot me a message, and would love to talk to you about what dynamic investing could look like for you.